Hi, this is Lex, and welcome to the Fintech Blueprint. It's your podcast about fintech, decentralized finance, digital banking, investing, robo-advice, artificial intelligence, and all the other frontier technology that is transforming financial services. To get more content, like an illustrated transcript of this conversation in your inbox, subscribe at fintechblueprint.com. So without further delay, let's jump into today's episode. Hi, everybody, and welcome to today's episode. I'm really excited to have with us Sid Batra, who is the co-founder of X1. We'll talk about X1 and the smart credit card that the company offers. It's a really compelling and interesting product, as well as Sid's experience at companies like Twitter and others being a technology entrepreneur. So with that, Sid, welcome to the conversation.
Thank you, Lex. Thank you for having me.
My pleasure. I'm going to keep all my questions about Twitter deep in my heart until maybe later. And instead of that, let's start with how you got into technology and how you started thinking about building things in the software world. What are kind of your foundational experiences that you think back and say, these really laid the groundwork for who I am today?
So going back in time, I have been programming and or building things since I was maybe like 9 years old. It's really funny because if you go back to that time, even desktop computers were not ubiquitous. And I grew up in India, and it was like an exception if you had access to one. So I was fairly lucky that when I was younger, around that 8 to 9 kind of age, I had access to like a desktop computer, and I was building things, programming, playing games, and that was kind of the initial foray into just software and building things. And on the side, I used to build like software programs which were used by like my dad's company, people in my high school. So that's how it all started. And I would say the most formative, deep experience that I had was when I was doing AI research at Stanford. That was like a group of just unbelievably talented people really pushing the boundaries of what software could do. So that was a lot of fun.
So before we get to Stanford and artificial intelligence, and we will, can you remember some of the first software programs that you wrote? Or what was one that kind of maybe sticks out as like the first one? And, I think thinking back to that time also, now we have developers, right? We didn't have developers back then. It was just programmers. So I guess what was the first piece of software that you programmed?
Yes, this is interesting. This is when I was in high school. My dad used to work at a pharmaceutical company. And with any pharmaceutical company, you have these like hundreds of salespeople, and they were basically going to doctors' offices where they would collect notes on like pen and paper. And and then those pen and paper would kind of come back to the office. It would all be like scanned, and that's how they would kind of keep a log of all the work they were doing. So I found that pretty dumb, like even at my young age, of like how much human effort is just being wasted. So my first like software application that what I call went into like production and was used by real people was this very simple desktop app where instead of like getting these notes that they had from doctors like scanned, they were just entered into like a software. And that allowed my dad and other people who were kind of senior managers at this pharma company to get a sense of like what were the day-to-day interactions for each of these salespeople, get basic analytics on them. So that was kind of the first software that I ever built.
So you went from building a CRM in healthcare. How old were you?
This is like 13, I would say.
Right. So from building a CRM at the age of 13, you went to Stanford to do much more complex stuff. And what kind of things were you focused on at Stanford?
So at Stanford, my research was around applications of machine learning in particular. And I was really obsessed by the idea of machines understanding images and video. So I did a really broad spectrum of stuff from like, how can you reliably identify objects inside of images? Like if that's a coffee cup, how can you reliably pull out all the coffee cups in an image? license plates from like images of like or videos of traffic. And perhaps the most pivotal thing that I worked on at Stanford, which ultimately became we got a patent for and became like a whole company, was this idea of machines deeply understanding like videos and then being able to change what is inside a video. The idea was that you could take this video clip and you could basically insert objects into it. It could be like a new object sitting on your desk. It could be a poster in the background. That was some really fun, novel research that eventually became a company.
Are you surprised at all by where machine vision is today?
Yes and no. I would say we're talking 2007, there was a lot more optimism around how much nonlinear progress you would get with machine vision. I would say, based on where things were back then, certain very specific things have gotten really good. Like if you look at iPhones today, every iPhone has like facial recognition and tracking built in, and it just works unbelievably well. So specific verticals have gotten phenomenally good. I mean, they're just in the hands of every single person on the planet. But I would say general machine vision and being able to like understand like images or more ad hoc use cases like that, those haven't quite been as impressive as I would have imagined back in like 2007.
Interesting. What do you think are the blockers? What's next?
I think it might just be a data problem. Like there is no universal data set that can teach a machine what different objects are, right? Like if you take the human equivalent, we spend so many years like teaching kids about how to identify things, what these things are, how they kind of work together. So there is no equivalent of data or a mechanism to teach machines that much. And so therefore, like specific applications which have a business use, they end up doing well. I talked about the whole facial recognition thing. The other example is like self-driving cars. There is a massive upside for a business if they can deliver a car that can drive on its own. In order to fulfill that, they just have to have like tons of data about a car, how it drives, and understand it deeply. So I feel like ultimately it gets driven by a business purpose, like this kind of innovation. And there is no like general purpose application yet from a business perspective. Once someone figures that out, I'm sure they'll find a way to make it more broadly useful. I just don't think there's any applications yet for a machine that can generally understand objects around them versus like a specific use case.
Maybe in the short and medium term, although I feel like the emotional labor that Bing's search chatbot is doing on various New York Times reporters is evidence to the contrary. You're doing this really sophisticated set of work, and this is quite early, right? This is 2008, 2009, way before the breakthroughs in Deep Dream and in neural nets around 2012, 2014. And you also start to experiment with launching your own products and kind of being an entrepreneur. Can you talk about the entrepreneurial itch, right? Like there's maybe this archetype of a scientist, of somebody who is deeply technical, creates aesthetic and well-architected answers, hypothetically, is able to do deep research. And then there is the archetype of the entrepreneur, sort of the sausage maker, the hand-to-hand combat, and the imperfect spark. What was it like for you? What had happened?
Well, my story of becoming a startup founder is quite accidental. As I mentioned, I was doing AI research at Stanford, and I was fairly oblivious to the idea of ever becoming a founder or creating a company. So one of these projects that I was kind of working on was this idea that, hey, you can take this video and you can change things inside the video, like add a poster in the background, put a coffee cup on the table. And we were doing these fun demos for people within the computer science department. And this is very emblematic of Stanford that the co-founder of YouTube was actually doing a PhD at Stanford. I mean, what are the odds, right? So he sees the demo and he's like, this is pretty impressive. You should try to make this into a business. I'm like, how so? He's like, you should use it to put like brand advertising inside videos. And this is like going back in time. This is like 2008 when YouTube was really taking off, but they were making no money. They were just hemorrhaging money. And everybody was trying to figure out how online video will get monetized in general. So that was the nudge that kind of started the journey. And as, you know, again, emblematic of Stanford, the one of our professors was actually an investor. His name is like David Sheridan. He was actually famous for writing the first check in Google. So we raised funding from him and we actually just made a business completely accidentally. It wasn't like any deep desire, but I just got thrown into it.
I remember a company, and I don't know, maybe this is the company you founded, but I remember a company that for the same movie, depending on the geography in which it was played, that movie, the product placement could be different. So the logos of, whatever products were available to be wrapped in advertisement, like depending on where that movie played, it would be different. And then also depending on when it would be played, different brands are relevant at different times. You'd be able to essentially use a rendered billboard space inside of the narrative. It sounds kind of dystopian, but it's also a really interesting idea to make that more reusable. Is that similar to what you were trying to get done?
Yeah, that's exactly it. The idea was that particularly applying it to like YouTube videos, like imagine instead of like having your experience of watching a video interrupted, there could be a very subtle kind of ad in the background. And the idea was like, this is where all the machine vision came in. It would look like that thing existed inside the 3D space of the video. So it would really match all the lighting, the colors. If someone walked in front of it, they would cover it. So it's basically as if something existed on the wall. So it looked really beautiful. It was a really phenomenal way of doing advertising.
So you are thrust into this entrepreneurial journey despite your best efforts. And then yada, 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 you are the director of engineering at Twitter. What happened in between? How did you fall into that particular whirlwind?
I think that first company, the video advertising one, really changed the trajectory of my life and kind of showed me a whole new universe that ultimately it doesn't matter how complicated or technically impressive what you're building is. Like ultimately it needs to be a business that can create value for customers and also capture some of that value. So that set me on a totally different trajectory of just creating companies one after the other. One of those companies in the team ended up at Twitter, where I spent a phenomenal 4.5 years, really had a blast there. And so my background went from being someone who's like an AI researcher to more like someone who builds consumer products.
What did you learn about consumers and consumer behavior while at the social network? Because a lot of people, me included, talk about the attention economy and the large artificial intelligence models that drive our behavior. And so, from the outside, that's kind of how it's interpreted. What was your view from the inside of people that use social networks and then their relationship with the content?
I would say there were some obvious things you saw where this is true for all these social networks, including Twitter, the people creating the content and the people who get the actual impressions, there may be like 5% of people who have 90% of the impressions of content. So it's very skewed. So what was interesting to me as like a kind of philosophical learning from all of this was social media is meant to democratize access, right? It's meant to say like everyone can have a mouthpiece. But what's very interesting is ultimately very few people end up having that mouthpiece and that access to a broader set of people. It's just that they at least have a shot at being one of those 5% of people who can have access, which is a nice thing, right? Because ultimately before this, it was mainly controlled by who is allowed to be on television or who is allowed to be on radio. This way, it is still a very extreme power law distribution, but it gives everyone the chance to have like a broader mouthpiece.
Why do you think that's the shape of the curve? Is it the shape of the curve resulting from some sort of natural, talent? What's the role of the algorithm for creating the shape of that curve? Like, are there ways to flatten that curve, or is it just the most clever growth hackers will sort of clump on it in a different way? Like, is the problem tractable, or is it just this is how things are?
I think it's technology and the internet in particular create these power law dynamics that are just inherent and you just can't undo them. They actually just keep getting more and more extreme. Because if you go back in time, take the example of maybe like someone who's a singer, right? Because you did not have any way of recording and disseminating music, every town would have someone who was like just a local singer, right? Who would be known in the town and they could make a living doing that. As you add technology into the mix, that equation gets more and more skewed towards the people who can make the best music. And that becomes like an extreme power law. Now I think Taylor Swift probably has like the vast majority of listens, right? And Rihanna and artists like that. So I think something similar happens with any kind of content. The people producing content on Twitter or like Instagram, everybody wants to follow the absolute best people, right? Who are creating the most engaging content. So that power law distribution, I think, is inherent to almost everything that technology will touch, particularly the internet.
How was your transition out of that towards fintech? What was the realization to move on and to do something different? And then why come closer to money?
A very interesting question. For us, if you look at, if you hear my background and the background of the founding team of X1, we all came from a background of building consumer products. So we had a very different perspective when we looked at the fintech and the finance landscape. What we saw was that almost all of the innovation and associated venture capital dollars were going towards the subprime audience. You saw these value propositions flooding the market like get your paycheck 2 days early, no fee banking, buy now, pay later. And this is all good innovation, but I looked at it and went like, look, as a customer, I don't want to use any of these products. And here I am still using a credit card that was literally like created in the late like 1980s and fundamentally hasn't changed since then. So for us and the team, the path became pretty clear. Like if we create a phenomenal credit card, reimagine it from the ground up, we can first build it for ourselves and then by extension the rest of the prime audience. And that kind of really set us on this journey, and it's been a really phenomenal last year and a half in particular.
Yeah, so maybe let's just do an introduction of X1, what the company does, what does it mean to have a smart card? Where have you gotten to? Kind of what's the scale of the company? And if you can share any volume numbers or user numbers, that kind of thing.
So X1 is the smartest credit card ever made. The team is diligently working on like every single day, every single week to continue to make this the best credit card a customer will ever use. And the last year and a half has been pretty kind of crazy for us. When we announced the product, we went viral and ended up with a wait list of 600,000 people. It was the largest ever wait list in fintech. And we spent no money on marketing, getting all these people to want our product. So that was quite surreal. Since then, when we launched the product, we went from basically no spending volume to now we do about $750 million in annual spending, and we're comfortably on track to hit like $1 billion of annual spend this year. And what was crazy was in a very short time, we went from basically being unknown to now we're the fastest growing challenger credit card of all time. We're also in the top 100 credit cards in the country, which was quite unbelievable. So it's been a really kind of rocket ship kind of journey over this last year and a half. And the customer and the market in general has responded really well to the value proposition that we put out.
Why do you think 600,000 people signed up on the waiting list? What is it that you think resonated behaviorally with this audience?
Yes, if you see what credit card companies have done basically since the late 1980s, it's been very heavily focused on marketing. Inherently, the product hasn't gotten too much better, but there's been a lot of efforts on like rewards and marketing and stuff like that. So our strength as people who build consumer products is like we can create phenomenal software that delivers like a really unbelievable jaw-dropping experience for the end customer. And in this era when customers are used to really great products, be it like what Amazon has done for them, what Uber can do, and so the product really resonated because they saw that we had innovated on the software consumer piece, but also we had spent a lot of effort making sure there's excellent branding with the X1 brand. There's a beautiful metal card. The rewards make sense. And they saw the software piece. So it was a combination of all these things that made it very successful. I often point people to the number one review that we have on the App Store. The first line literally says, "This card is the total package."
Tell me about the software. What does the software do that's different from, let's say, what another card gets me?
I'll start by giving you an absolutely trivial example that really will sound kind of almost silly in hindsight. So the number one job of a credit card is to let the customer spend money, right? Pretty straightforward, right? But none of the cards in the US, they don't even show you the card number in the app or the website. So now imagine in like 2023, I could be, let's say, sitting on my couch. I'm on TikTok. I see an ad for TikTok leggings. I want to buy them right away. I literally have to walk up, get my wallet out, put that card number in. It's like unbelievably old school. And again, this is a trivial thing. We found a way to show customers their card number in the app. And now you can imagine, like, what is the single most used feature of the app? People want the card number out of it. It's a very small example, but it has a very interesting ripple effect. Because we show you the card number in the app itself, when a customer applies for the card and gets approved, they don't have to wait 7 days for a piece of plastic to show up in the mail for them to start using the product. They immediately go from like getting approved into the app where their actual card number is available to spend instantly. And a significant percent of our customers have already made their first transaction before even getting the beautiful metal card in the mail. That's an interesting ripple effect. The other ripple effect is that imagine you're traveling. Imagine I'm kind of traveling and doing my touristy things and I lose my card. If I had an old school card, I'm basically done at that point because they're not going to ship the card to me in London. They'll just ship it to me to my home address. But with X1, I press 2 clicks. I get a new card number instantly in the app. That card number can be added to my Apple Wallet. And then I'm basically ready to go, right? Like as if nothing happened. So that instant peace of mind is really powerful in this case. So that's like a very trivial example that ends up becoming really powerful and compounds as time goes on. I'll give you a more complicated example. We built this amazing product called virtual cards. And virtual cards, most people are kind of familiar with the concept. These are disposable card numbers that are tied to your credit card account, but are a completely different number than your actual number on your physical card. We productize them in a very interesting way. So there are a few types of virtual cards. There is a standard virtual card which allows customers to cancel subscriptions in a single click. So say I want to sign up for my gym membership. Instead of using my actual physical card number, I use this like disposable virtual card number. Now, inevitably, when the New Year resolution rush kind of fades off and I want to cancel the gym membership, gyms would normally make me show up in person to the gym to have that awkward conversation and then cancel cancel my membership. Here, I can just wake up in my bed, press a button, gym can never charge me again. So it really shifts the power dynamic from the merchant back to the customer. Another example is like free trial cards. We are inundated with free trials these days. Like everything is like, try this for 30 days and then if you like it, you can pay for it. But what happens? Eventually we forget, right? And then you end up in the cycle of forgotten subscriptions that all add up. With a free trial virtual card, you get this number, you put it into a free trial, and the card immediately self-destructs. And so you can kind of enjoy your trial with complete peace of mind, and the merchant can basically never charge you. So this is a more complicated example of what we built that was pretty hard to do, but delivers tremendous value for the customer. Something like half our reviews mention the virtual cards. So hopefully this gives you a sense. And this is just like us getting started. All this is live in the product, but we've already delivered so much unique value through the software. And we're also building a lot of very interesting things in the future.
Yeah, so it's really interesting, the examples you picked, because they're not how can we bribe you more with, interest rates. They're not financial features, they're behavioral features. One of your examples gave me PTSD because on a trip to LA, I had an HSBC card and a Bank of America card in the back of my phone case. And of course, I left them both on the airplane. And getting off the airplane and getting into an Uber with no payment mechanism, and then the need to also destroy the cards that are out there, locked me out of the entire financial system in 2 countries in a single evening. That second example you gave is a real pain point. I did end up kind of hacking around because I am in fintech and it's my job. And so there were 2 ways I was able to almost get there. The first was TransferWise, which also does virtual numbers. The problem with TransferWise is that they actually KYC, AML you, and lock you out. Can you guess who gave me what I needed and tapped directly into my bank account?
Now you tell me.
Revolut. Revolut does the service. So I was caught at the time. If I had an X1 card, I think that would have definitely solved my issue. The question I've got around this value proposition, there's two things. The first is I'm curious to know kind of your, like, what the entity is, like who issues a card. It's a Visa card. What is X1 relative to the card networks, relative to banks, right? Usually it's the banks that are offering the card. Is it a prepaid card? Like, can you describe the underlying kind of regulatory structure in order to be able to do this?
We made the choice that we are going to create a true revolving traditional consumer card, right? Consumer credit card. So this is not a charge card. This is not a prepaid card. This is the structure is identical to a credit card that you might get from any of the large banks. And it is a much more difficult choice than doing any of the other options, but it is what consumers want. The team probably lost a few years of their life on the back end. I certainly did. I feel much older having gone through this journey of going from this massive waitlist to shipping the first live credit card. It was excruciating. And the way it works from like a regulatory perspective is in the US, as a startup, you just can't wake up and start like giving credit cards to folks. You need to partner first and foremost with an issuing bank. The issuing bank already has the legal ability to issue card to anyone in the country. And we partner in a way where from a legal construct, it belongs to the issuing bank. Legally, it is their customer, it is their like card. We are responsible for like marketing it, building the product, everything else. From a customer perspective, it's obviously like they think of us as like the card, right? It's the X1 brand that they're getting. Behind the scenes, it's the issuing bank's card, and we have to bring like our own capital into the equation. So we have to raise like separate credit facilities in order to fuel the spending on the credit card, which is another reason where it's much more complicated than like a prepaid card. Because in a prepaid card, you're just spending your own money, right? You pay for it, the money's there, then you just spend it. With a credit card, you have to give customers a float. That float could be 30 days if they pay it off at the end of the month, or that float could be several months if they choose to carry a balance. So it creates further complication because the regulations are tougher for something like this. You require a banking partner, but also you need to bring a capital facility into the equation. And lastly, in order to make sure the card can work everywhere in the country and in the world, you partner with Visa as the network.
You are doing some underwriting of the personal loans, essentially, of the personal credit facility for the user. Is that right?
So the way we constructed this is almost everything that is like a core part of the credit card. To your point, the underwriting, credit policy, which means who gets the card, what their limit is, what their pricing is, understanding like if a customer is fraudulent or not. Like, is this like a stolen identity? Is it who they say they are? KYC, building the actual financial ledgers, payments, credit reporting, anything you can think of. All of this infrastructure we built in-house. Because for us, like I mentioned, the ultimate long-term differentiator is going to be what we can build as far as the consumer experience and the software side. And it's very important to be able to control all of these key pieces of the stack so that you can create a lot of nonlinear value for the customer. So almost anything fundamental about the credit card, like we're doing ourselves.
In terms of your economic model, you've got the underwriting bit, and then you have, I assume, interchange when they spend, right?
Yeah, the beauty of the credit card is that the business model is proven and has been like stable for decades. So we make money in three interesting ways. The number one is interchange revenue, like you said. Number two is interest revenue. When customers carry a balance, we make interest revenue on that. And lastly, also, we have this third bucket of like what we call ecosystem revenue that's driven by like software stuff. So those are three kind of high level streams of revenue for us.
Since this is a private label experience, it's not like somebody's going to the bank website and using their bank app. You have a dedicated experience for the card. So you're essentially layering on a PFM on top of the card spending, but then integrating all these other features that are endemic to a credit experience into the PFM. You're not kind of caught in this building a PFM and financial planning in order to sell cards. You've already sold the card. You're providing it to make the experience of the user better.
Yes, absolutely. And in order to make that experience better, it's very, very important to own the entire stack. Take a counter example, right? Probably the biggest missed opportunity in credit cards was the Apple Card. Apple essentially took the credit part of the business and outsourced it to Goldman Sachs. So they don't do any of it. So they're basically just what I would say, a slightly nicer UI on top of a very traditional kind of like banking experience, right? That inherently limits what they can do with the product. For us, it was very important to own that end-to-end piece. And maybe a small example to illustrate this point. We are the only credit card in the country that allows you to auto pay every week, every 2 weeks, and monthly. And what's very interesting is this is like you can only do this because we have direct banking APIs to do payments ourselves from our customers' bank accounts. We don't outsource it to like either a payment processor or to like a bank. This is a very simple feature, but allows our customers to keep their utilization in check. It reduces our cost of capital. And it is only possible if you own the stack and you don't outsource the rest of it to someone else.
And I think you've answered my other question that I've been holding, but it's still maybe worth serving up, which is there's so many different ways to try and fulfill the financial needs of the segment that you're targeting. And I think it is very novel and differentiated that you've decided to enter the segment positioned as a smart credit card. Like it's counterintuitive relative to what everyone else is doing, right? And what are the other approaches into the space? The other approaches into the space are the neobank. So let me hold your assets, not your liabilities. Let me track your spending and so on. And yes, you get cards because you are a client of my neobank. But the point of the neobank is to maximize deposits. Or there's a tension between the monetization and the activity, often between what the digital bank wants people to do and kind of how it's marketing and what it's getting people to do, where money in motion versus money at rest, the business models are a little bit mixed. The other path then is the Venmo kind of Cash App path, right? Which is being the payment wallet. So I want to control your spending, or I want to facilitate your spending and make your spending easier and digitize all the cash flows in your life. And yes, maybe you'll get a cash account. And yes, maybe you'll get some physical instruments to spend in a point of sale capacity or something like that. But those are kind of the familiar forms, the neobank and then the digital payment wallet. And you've got this positioning as a card. And there's something really different about that. And I wonder how explicit that was in your thinking. And then, you've explained why you went this route, but, is there anything else about how you decided to not be a payments company or how to not be a digital banking company, but to be this particular form factor?
For us, we were building the product for ourselves as customers to begin with, and then by extension, the prime audience. And what's interesting about the prime audience in the US is that almost all of their spending happens on the credit card. And so if you want to go serve the subprime audience, you have sort of this wedge where you can say, look, I'll give you a bank account. I won't charge you any fees. And that allows an entry point. For the prime audience is pretty hard to penetrate because take the example of like a neobank, right? Like they don't hate their banks. Like I, as a customer, I still have my very old Bank of America account. Could it be better? Absolutely. Could it be a step function better? It's very difficult to make a step function better bank account for a prime customer because I don't get charged any fees. I don't want my paycheck 2 days early. So it leaves very little degree of freedom. The credit card, on the other hand, is your kind of key spending instrument. And so our approach was that if we can take this spending instrument and create a step function better product for this prime audience, it will allow us to actually segue in very smoothly into other product offerings as well. I gave you a small example of something we're doing. And this is going to launch maybe in like a couple of weeks from now. We are the first company ever, or credit card ever, to launch a trading platform where you can buy stocks with your points. So imagine the most credit cards, you come in, you have some points, you can take those points and maybe get some cash back or statement credit. With us, you can take these points and literally get like stock back, all managed in the X1 app. So it's a pretty like stunning experience, because what happens from a customer perspective is it's probably the only brokerage account they open where there's already money in there to spend. Like your points are already available, basically like cash to kind of buy stocks. And this isn't possible in any other situation, right? Where if, let's say, you're Venmo, it's very difficult for you to then get into, let's say, investment accounts from there, because that relationship isn't quite there. You don't have enough money in Venmo, and you're not like an active user in the sense that you can transition somebody from using Venmo to then using Venmo's like stock buying experience. But if you have access to someone's primary spending instrument, like you are the primary spending instrument, you can create all these very interesting kind of product segues. Like you can create like stock buying from there. You can also actually create a Venmo replacement from there. So I think owning that spending instrument was very fundamental to how we wanted to approach the market.
That's a really interesting framing, a spending instrument. And I think there's something about the physicality of it as well that makes it tangible. You end up having a brand that lives inside of an object rather than having a brand that, spins off multiple objects and multiple artifacts, but there's not kind of a clear instantiation of it. So I think there's something clever about building the experience of the entire digital suite into this physical product. I want to ask you, jumping off of some of the ideas that you mentioned, whether the plan was to do this super app destination, this kind of B2C fintech super app destination that lots of companies are interested in, from SoFi to others, where you might have an entry point through spending, but what's really on the other side is money at rest or brokerage or investment accounts and robo-advice and insurance and things like that. Are you seeing yourself as going into those other directions and expanding into other financial verticals, or are you kind of keeping it tight and narrow and moving straight still through kind of market penetration?
So our long-term desire is to create a gigantic like consumer finance company. And you are right that a lot of other companies have a similar ambition, right? So I think the question becomes like, why do companies want to do a series of products rather than the first product, right? For us, the only reason to do it is because our ambitions are pretty big. We don't need it to make the business model work, because credit cards are a really proven like old business model. We can take a company fully public just on credit cards alone. So we're doing it because we feel we can truly create like non-linear better experiences for customers by centering everything around the credit card. If you take the example of something like, take like Robinhood, for example, phenomenal company, right? They had to create a new business model, the payment for order flow, because they don't charge any fees on stock transactions. And that makes it very difficult to monetize the customers efficiently. And for a point of reference, Twitter makes more money per customer in the US per year than like Robinhood makes per customer, right? And that's pretty backwards in my view. So there's a lot of pressure on Robinhood, as you've seen from their financials now, to create another product that can really monetize the huge audience that they've amassed. So they need it in order for the company and the business model to succeed. For us, we don't need it. We only will build products like buying stocks or sending money or whatever else in the future, like deposit accounts, because it can truly be like a game-changing product for the end customer. We have no pressure on our like fundamental business model that will force us to do that.
But it is in the scope. It is attractive.
Oh, 100%. Like, absolutely. I think, and the fundamental reason is that interoperability in the US financial system is pretty bad. Like, it's very difficult to move money. It's difficult. It's slow, often expensive. And so it makes sense to try to put everything under kind of one umbrella and like one experience for the customer.
Yeah, absolutely. And I think finding the right angle, especially one that connects with the core thing that your segment wants, is really difficult. And I think the viral outcome you've been able to create is quite remarkable. You're not paying $200 per credit card customer as a bank would. You're able to create viral loops and referral loops within the product as well. Are there any learnings that you had from the social network experience that are applicable to growing this type of fintech product? Are there things that you think you've been able to take and deploy that puts you at an advantage relative to other fintech founders?
The way we approach every problem in the business has been shaped by that background in consumer products. Take the example of maybe like growth, for example, right? If you were a traditional credit card, your growth mainly comes from like running ads and things like affiliate partnerships. Very effective, like you say, like it just works, right? You just spend some money, you get customers in. And for us, like we can absolutely do that. But we also approach the problem from a consumer product lens. And in order to make that happen, we actually, for all of the folks in the company who work on either engineering, product, or design, we explicitly don't hire from a finance background. And this allows this group of people to actually just create like the best consumer product approach to the problem. So from a growth perspective, like we spend a lot of energy on referrals, right? Which is a key kind of lever for any consumer product. And here's an interesting stat. For most traditional credit cards, even the best of them, they're getting somewhere between like, let's say 2% of customers through referrals. That number for us is like closer to 20%. So by building it with a consumer product muscle, our referrals are doing like 10x better than a traditional credit card. And obviously then we get the benefit of like a cheaper cost of acquisition as a result. Another example is we explicitly build products that have like a viral mechanic in it. One of the products we're going to release in a few weeks is the idea that you can use your credit card to send money to anyone in the world. And that experience is inherently viral, right? Because anytime a customer uses it, you create an impression with someone who's not a customer. So that background in consumer products has basically given us this training of how do you grow a consumer product, because often you can't throw that much money on like marketing for a pure consumer product. And then we pair it with all these finance learning. So it changes like the approach we take to every problem, like margins or growth.
It sounds like there's a real magic sauce to it that has created like amazing growth for the company. And I'm really excited to see how it continues to develop. If our audience wants to learn more about you or about X1, where should they go?
So for X1, you can go to x1.co. That's where the credit card website is, the company website. And for me, I'm on Twitter. You can search for Sid Batra on Twitter. That's my handle.
Sid, such a pleasure having you on today.
Lex, really appreciate it. This was a really fun conversation.
Hi, everyone. That's it for this week's episode of the Fintech Blueprint. For more technical deep dives into all things fintech and decentralized finance, check out fintechblueprint.com and grab a free subscription to the newsletter. This is Lex, and I'll see you next time.